Greetings, everyone. Welcome to Liberty Call this Thursday, September 1st, 2022. First day of September. It's a very, very exciting time of the year. Football season's right around the corner. Got some exciting games this weekend. The Seminoles will be playing LSU on Sunday, and the Cougars going to be playing UTSA, I think, on Saturday. I forget which. And unfortunately, the Astros are off today. Very sad because I'm a huge baseball fan. And anyways, a better day in the markets from the way it looks. Well, at least for a couple of the indexes, they finally moved into the green. Looking across the asset classes, everything mostly looks red. So certainly not the best day in the market. Let me scroll through the rest of the world. Yeah, mostly red across the globe, but maybe it's a pump and dump. Who knows what the big institutional players are doing, trying to head fake everyone else out and make a buck. So anyways, if it's your first time watching, give me a big old slam that subscribe button. Give me a big old like, share, subscribe, all those big old thumbs up. I really appreciate it. It makes my life much easier when people are actually paying attention. Anyways, sorry, my beard's a bit of a mess today. So anyways, need a little bit of a trim. See, my hair's a little long. I went out and about, I guess on Tuesday. I had to go run and pick up mail at the office, but have not had a reason to shave the head. So it's looking a little shadowy today. All right, well, let's go ahead and take a look and see how the markets did today. The Dow Jones was up 0.46 or 145 points, closed at 31,656. S&P 500 was up 0.3, closed at 3966. NASDAQ down 0.26, closed at 11,785. Small caps were down 1.61. The VIX fell today 1.2% to 2556. It was up a couple percent earlier in the day. The other Americas, Canada was down 0.97, Brazil up 0.81, Mexico up 1.03. Jumping across the Atlantic, Germany down 1.6, UK down 1.86, France down 1.48, Euro Stoxx was down 1.72. The Netherlands was down 1.97, Spain down 1.02, Italy down 1.19, Switzerland down 1.76, Portugal down 0.56. Moving further east, both Russian markets were in the green. The MOEX up 1.9, the RTSI up 1.67. Headed over to the Asian markets, Japan was down 1.53, Australia down 2.02, New Zealand down 0.32, Shanghai down 0.54. Let's see here. The SCSE component down 0.88. The China A50 down 1.38. The DJ Shanghai down 0.59. Hang Seng down 1.79. And the Taiwan weighted came in down 1.94. So as you can see across this screen, we see nothing but red except for a few outliers here and there. Was a pretty ugly day, all things considered, for the 1st of September. And who's calling me? I'll have to call you back. Let's see here. Well, let's go ahead and run through today's market recap and see what Yassin Ibrahim had to say from investing.com. This is titled Dow Snaps Losing Streak as Dip Buying in Big Tech Returns. The Dow snapped a 4-day losing streak Thursday as dip buying in big tech helped the broader market fight back losses following a wobble in chip stocks ahead of the monthly jobs report due Friday. The early slide in big tech attracted dip buyers despite the ongoing climb in treasury yields as data showing the labor market remains robust and manufacturing activity improved is expected to support the Federal Reserve's plan to persist with rate hikes. Initial jobless claims fell 5,000 to 232,000 in the week ending August 22nd or 7th, confounding the consensus call for claims to rise to 248,000. Quote, the labor market remains very tight and the claims data do not show any shifts in momentum, end quote, Jeffrey said in a note. Manufacturing activity, meanwhile, climbed to a reading of 52.8 in August, above the consensus of 52. The strong labor market data comes a day ahead of the monthly jobs report expected to show the economy created about 300,000 jobs last month. Chip stocks also paired some losses, though ended the day in the red after AMD and NVIDIA fell following new U.S. government restrictions on the sale of artificial intelligence chips to China. NVIDIA said about $400 million of sales in China could be affected by the rule, sending its shares more than 7% lower. AMD fell 3%. The chip maker said, however, it would apply for a license to continue some China exports, and some analysts believe the company will likely be granted an exemption as the chip maker's customers in China aren't linked to the Chinese government. Yeah, because Chinese government doesn't have their fingers in everything. Quote, we believe NVIDIA's largest Chinese customers are large internet cloud companies that are not affiliated with the Chinese government/military, end quote, said Wedbush in a note. Seagate Technology, down nearly 2%, also added pressure on chip stocks after the memory storage company cut its sales outlook amid worries about a deteriorating global macroeconomic backdrop. Twitter fell less than 1% after confirming plans to roll out an, quote, edit tweet feature, which will be expanded to Twitter Blue subscribers in the coming weeks. In earnings news, Campbell's Soup slipped 2% after the food producer's better-than-expected quarterly results were overshadowed by worries about the risk of growing inflation pressures. That's kind of funny. They beat their expectations, and their stock price falls. Because, I'm sorry, if we go into a really bad recession, what do you think people are going to be eating? Soup. I mean, they're not going to be eating filet mignon, people. Anyways, Signet Jewelers delivered mixed quarterly results as revenue fell short of expectations, and the company said it continues to expect demand for jewelry to fall as consumers shift spending to experiences. Again, if the world falls apart, they're not getting experiences, they're not buying jewelry, they're going to be buying food. All right, well that's the basic recap. Got some labor news. U.S. labor market manufacturing resilient despite rising interest rates. The number of Americans filing The number of Americans filing new claims for unemployment benefits fell to a 2-month low last week, while layoffs dropped in August, suggesting the Federal Reserve would need to continue aggressively raising interest rates to slow the labor market. The weekly unemployment report from the Labor Department on Thursday, the most timely data on the economy's health, also showed fewer people applied for jobless benefits in the week prior than initially estimated. Strong demand for workers was reinforced by the Institute for Supply Management, or ISM, survey on Thursday that showed a sharp rebound in manufacturing employment in August after 3 straight months of contraction. The ISM survey found that, quote, companies continued to hire at strong rates in August with few indications of layoffs, hiring freezes, or headcount reductions through attrition, end quote. The Fed has been delivering hefty rate hikes to tame inflation by dampening demand in the overall economy. Quote, employers remain in a mad scramble to fill open positions and are likely holding on to staff despite ebbs in demand, end quote, said Matt Collier, an economist at Moody's. Quote, the experience of the past year and in an extremely competitive labor market and fast-moving business cycle leave businesses loath to let workers go, end quote. Initial claims for state unemployment benefits decreased 5,000 to a seasonally adjusted 232,000 for the week ending August 27th, the lowest level since late June. Data for the prior week was revised to show 6,000 fewer applications than filed than previously reported. Economists polled by Reuters had forecast 248,000 applications for the latest week. Unadjusted jobless claims slipped 2,492 to 176,793 last week. There were notable declines in Connecticut, Missouri, Oklahoma, and Georgia. The drops offset big increases in Massachusetts and New York. The number of people receiving benefits after an initial week of aid, a proxy for hiring, increased 26,000 to 1.438 million in the week ending August 20th. The government reported this week that there were 11.2 million job openings at the end of July, with 2 jobs for every unemployed person. Labor market resilience continues to dispel fears that the economy is in recession after GDP contracted in the first half of the year. Moving a little further down, 5 of the biggest 6 manufacturing industries, including machinery, transportation, equipment, and computer and electronic products, registered moderate to strong growth. Let's see here. The claims data has no. The claims data has no bearing on what are they talking? Oh, they're talking about the claims for unemployment. The claims data has no bearing on August employment report, which is scheduled to be released on Friday, as it falls outside the survey week. According to a Reuters survey of economists, non-farm payrolls likely increased by 300,000 last month after surging 528,000 in July. While job growth is slowing, labor market conditions remain tight. A separate report from global outplacement firm Challenger Gray and Christmas on Thursday showed job cuts announced by U.S.-based employers fell 21% to 20,045 in August. Though layoffs rose 30% from a year ago, they were down 27% in the first 8 months of this year compared to the same period last year. The technology industry accounted for nearly a quarter of the job cuts announced in August. Technology companies have announced 14,408 layoffs so far this year, a 70% surge from the same period last year. Overall, employers announced plans to hire 41,985 workers in August, up 65% from July. And another report from the Labor Department showed non-farm productivity dropped at a 4.1% annualized rate last quarter, revised up from the previous 4.6% pace of contraction reported last month. It tumbled at a 7.4% rate in the first quarter. Productivity fell at a 2.4% rate from a year ago instead of the 2.5% pace estimated last month. It was still the biggest year-on-year decline since the government started tracking the series in the first quarter of 1948. So again, it's kind of a mixed bag of things as far as, the employment numbers look good, but productivity is slipping. And, in some areas there's layoffs, other places there's not. So again, it's kind of some is good, some is bad. All right. Next article up is a prediction from Mr. Michael Burry. For those who are unaware, he was the subject of his character was Christian Bale's character in the movie The Big Short about the financial meltdown back in 2008 and 2009. And it's a good movie. If you haven't seen it, I suggest going and watch it. It really gives you a inside look at how things are so messed up in a lot of the financial industry. All right. This is titled Michael Big Short Burry makes another dire prediction. Michael Burry rose to fame after the 2015 film The Big Short depicted his bet on the subprime mortgage meltdown, which sparked the 2008 financial crisis. The financier has since become a market salesman. He mainly plays the role of Cassandra. The name of his profile on the microblogging website Twitter, never heard it referred to that, is Cassandra BC. He's the bearer of bad news and has been delivering it for the past few months. The investor who recently liquidated his entire portfolio of U.S. stocks says the worst for the economy is yet to come, as the Federal Reserve Chairman Jerome Powell reiterated on August 26th that the central bank would continue to raise interest rates aggressively to fight inflation. The monetary tightening will lead to a hard landing for the economy. In other words, a recession, some experts say. Burry did not wait to start pointing out potential red flags for the economy, like a household debt crisis that pose a serious danger. Quote, net consumer credit balances are rising at a record rates as consumers choose violence rather than cut back on spending in the face of inflation, end quote, the legendary investor posted on Twitter August 12th. He included a graph from Bloomberg showing the U.S. consumer borrowing increased by $40.2 billion in June from the prior month. That was the second biggest increase ever, according to the data from the Federal Reserve. Quote, remember that savings glut problem? No more. COVID helicopter cash taught people to spend again, and it's addictive. Winter coming, end quote, Burry added. Winter coming seems to refer to the HBO series Game of Thrones. Characters use the phrase as a warning. Nearly 3 weeks later, the financier did it again with a very gloomy prediction for the markets. Indeed, he seems to say the stock market collapse is a matter of when, not whether. Quote, and yet I keep getting asked when crash, end quote, Burry tweeted yesterday, August 31st, with a Bloomberg chart showing the movement of the S&P 500 since 2017. On a graph, he highlighted the fact that the stock market benchmark has fallen 18% since its high in December. And here's the chart. I actually saw it yesterday. I follow that. There's a Reddit group or sub that is titled Burryology, I think. And so basically, because Michael Burry deletes a lot of his tweets. He'll put a tweet out for a couple of days and then it's gone. So this Reddit page basically screen grabs everything. And so you have like a chronological order of everything he posts throughout the years. And so, yeah, I saw that yesterday and people were making comments. Granted, Reddit is a pretty left environment, so you don't always get a lot of good commentary on it, unfortunately. Burry has been right this year. Burry seems to feel that a stock crash is shortly going to happen. In May, the investor predicted that the S&P 500 could fall to 1862 points over the following year based on crashes of the past. And last check, the index was around 3908. From there, his call would be a drop of 52%. Quote, regarding paradigm shifts, speculative peaks, the S&P 500 bottomed 13% lower from 2002's bottom in 2009, 17% lower than 1998's long-term capital management crisis low in 2002, and 10% lower than the 1970s low in 1975. 15% lower than the COVID low is SPX 1862. That's the standard S&P 500. Schiller PE of 16, nominal PE of 9 in historic range, end quote, the Scion Asset Management chief posted on Twitter May 3rd. The cause of his pessimism is that the greatest speculative bubble of all time in all things has created since the summer of 2021. That's particularly because small investors went heavily into meme stocks and cryptocurrencies, portending the mother of all crashes. The financier has been right so far. The cryptocurrency market has lost more than 2 trillion since it peaked last November, according to data firm CoinGecko. Bitcoin, the largest digital currency by market value, has lost more than 71% of its value since its November record. The S&P 500 and NASDAQ indexes, by contrast, have lost 18 and 25.4% respectively since January. Burry's tweet drew a lot of comments on social media. Some users pointed out that the year had been very bad for the stock market, while others were convinced that a crash was imminent. Quote, there's no reason for a market crash that hasn't been priced in. This has already been the worst year for the market ever. Unless there is some catalyst market crash event, he is just staying what every TA guru is saying by simply copying the 2008 chart, commented one Twitter user. So yeah, this Twitter user seems to think that he's full of hot air. So again, take his prediction with a grain of salt. The guy's pretty smart. So I at least listen to what he has to say. And most of his chart observations are fairly spot on. So all right, last article I got here has to do with the student loan thing that I personally am not a huge fan of. It looks like some states could potentially charge, could be a tax, be some tax implications for some folks. But we'll see. I personally, like I said, I don't think it's actually going to go through. I think it's going to get snatched back through some litigation, and then the blue team will use it as a reason to get the vote out, because the evil red people are taking away the free money we're giving you, which, again, we know it's not free. But anyways, let's go ahead and read through this real quick. 6 states could potentially, and let me preface this by what they're talking about here is, based on my own experience of being a credit and collections agent for the better part of a decade in the late 90s, early 2000s. When you settle a debt, which essentially is what this is a settlement or a write-off. And, so for an example, when I was working for Citibank, and let's say someone had a $10,000 credit card balance, and if it got to my desk by the time, when I was, more of a senior collector back in those days, if you got to my desk, your account was already closed, getting ready to go to charge off, and was getting ready to go to a collection agency. So I was kind of the last person you were going to get to talk to before you started dealing with agencies. And so we would do things, what's called a settlement. So someone had $10,000 balance, and they're now 4 to 6 months late on making on arrears on their payments. We had the latitude to offer settlements on the account. And it was based upon delinquency and a bunch of other scales. But I think I think we'd take like 20% off if they were like 4 months late, maybe 30, 40% off if they were 5, and then up to like a 50% settlement if they were at the 6 month right before charging off to the agencies. So in this example, if it was say 6 months late, we did a 50% settlement, that instead of paying, $10,000 to clear up the balance, we would do they would pay us 5 lump sum. You don't get to make payments on a settlement. I mean, yeah, if you stretched it out over, 2 months, it wasn't the end of the world. But, so the $5,000 that was never going to be paid off was considered a charge off. And, we would write off that, or not we, it wasn't me, Citibank would write off that portion of the balance, and then they would get a 1099 net the following year for, because that was considered income to the debtor, essentially. So that, if that person made $50,000 that year, they actually made $55,000 for tax purposes, and they'd have to pay income tax on that amount. So that's what they're talking about here in this article. So let's dive in. 6 states could potentially charge borrowers income tax on their forgiven student loan debt. Most borrowers eligible for President Joe Brandon's student loan forgiveness plan will receive the relief tax-free, but residents of a handful of states may be on the hook to pay state income tax on the canceled debt. In the past, when federal student loan debt was forgiven under certain established government programs, including income-driven repayment plans, the canceled amount was counted as taxable income. Student loan debt forgiven under the Public Service Loan Forgiveness and some other programs is not taxable. But in 2021, American Rescue Plan changed that temporarily. Student loan debt that's canceled between 2021 and 2025 will not be counted towards federal taxable income. Most states will, quote, likewise exclude debt forgiveness from their own state income tax bases, end quote, according to the Tax Foundation, but not all. Arkansas, Massachusetts, Minnesota, Mississippi, North Carolina, and Wisconsin, quote, appear to be on track to tax student loan debt forgiveness, according to the Tax Foundation, after pronouncements from state officials, end quote. Let's see here. That's for a variety of reasons. Some states are known as conforming states, which means they follow federal tax law, but they can decouple from federal law, which means student loan forgiveness would be taxed. Others are non-conforming states, and it would take a legislative action to exclude the debt relief from state income taxes. So it is possible states could enact something, typically a state law, to exclude discharged student loan debt from income tax in the coming weeks or months, or clarify that they will follow the IRS's lead. New York recently took steps to do just that. While it initially appeared as if residents would be on the hook to pay state income tax, the New York Department of Taxation and Finance told Fortune that New York is a conforming state and will follow the IRS unless a state law has been enacted to decouple from the federal law. Therefore, unless the state legislature or Governor Kathy Hochul, she's such a nice lady, quote, affirmatively decide to tax it, end quote, which is not expected, eligible New Yorker student loans will be forgiven tax-free. Fortune reached out to the tax departments of the 6 other states listed above for more information. Scott Harden, a spokesman for the Arkansas Department of Finance and Administration, said the state is currently reviewing whether debt forgiveness made via executive order, which is how Biden is instituting it, is subject to income tax. Quote, as a state does not automatically adopt federal tax policy changes to our state income tax law, we must determine whether existing state law would consider this taxable income, end quote, Harden said. Quote, we anticipate a determination will be made within the next several days and shared with taxpayers and media, end quote. If Arkansas Finance Department determines federal loan forgiveness is subject to state income tax, it can only be changed by legislative action. The next session of the state's General Assembly is scheduled for early 2023, according to Harden. Similarly, excluding debt forgiveness from taxation requires a statutory change in Wisconsin, which requires legislative action. Quote, we will address this discrepancy with federal law in our upcoming biennial budget request in an effort to ensure Wisconsin taxpayers don't face penalties and increase taxes for having their loans forgiven, end quote, says Patty Myers, communications director for the Wisconsin Department of Revenue. In Minnesota, a provision to conform to the American Rescue Plan was not passed during the last legislative session. Quote, if the state does not conform to this federal law, then Minnesota taxpayers who have their student debt discharged will have to add back this amount for Minnesota income tax purposes, end quote, a spokesperson for the Minnesota Department of Revenue told Fortune. The Mississippi Department of Revenue and North Carolina Department of Revenue said the forgiveness would count as income and be taxed in those states. North Carolina's tax agency is, quote, monitoring any further enactments by the General Assembly that could change the taxability of student loan forgiveness in North Carolina. And the Massachusetts Department of Revenue tells Fortune that it expects, quote, federal student loan forgiveness will not be taxable in Massachusetts, but the final determination will be made once all guidance and details are available from the federal government, end quote. This is an evolving issue, the Tax Foundation notes. So, yeah, if you live in one of those, 6 states, where were they? Let me repeat them again. Arkansas, Massachusetts, Minnesota, Mississippi, North Carolina, and Wisconsin. You may be on the hook for a few bucks if it in fact does actually go through. So, all right. Well, that's everything I had for today. I hope everyone has a wonderful evening. I'll be back tomorrow with the weekly wrap up, going through all the economic data, how the markets did for the entire week, and any other news that does come up. So I hope everyone has a fantastical evening, and I'll be back tomorrow. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information there is there. So have a good night. Adios.